Hi, Bharat from freefincal. So you must have heard about the Bharat Bond ETF. This is an FAQ about the ETF, which is going to open for subscription from tomorrow up to the 20th of December 2019, and then it will be available in the secondary market for purchase. So let's find out. Is this the answer to credit problems in, in debt mutual funds? Are there any better alternatives? So I'm just going to run through the FAQ. So this is going to invest in public sector bonds. Many people have the misconception that it will only invest in AAA bonds. That is not true. And many people also have the misconception that the returns will be very close to the indicated yield. That is also not true, even if you hold the ETF to maturity. So this is the let's take a look at it. So why was it created? So they just want to fund the activities of the public sector organizations, and they choose the ETF route because it's a low cost product, and they can invite institutions. They can invite institutions to participate. This will be insurance companies, pension funds, mutual funds, other big players, and they also are hoping that trading and liquidity will increase. Just like you have the Bharat ETF, the PSU ETF, the government is hoping that the trading will be high in this as well, which is a good thing for the companies and the general bond market. So Edelweiss will be managing the ETF. They've been given the mandate to do that, and it's quite amusing that they have chosen to have a fixed maturity ETF. That's a closed-ended ETF. So which means that there are two options. There's a 3-year ETF and a 10-year ETF. So which means that the ETF will be in operation for 3 years from launch, a little more than 3 years. So it'll launch in December, and it will be in operation until April 2023, which is almost like 4 months more than 3 years. The reason for that is up to 3 years, the taxation on any capital gains will be as per slab. It has to be more than 3 years to qualify for taxation with indexation at a flat rate of 20%, and that's the reason why the government has made it more than 3 years, and it will mature. So the ETF will run up to April 2023, and it will mature. In between, the ETF can be freely traded, and if you trade the ETF, you have to pay as per tax on the capital gains. But if you hold the ETF until maturity, then you are eligible for 20% taxation with indexation. Please remember, this is independent of tax slab. So even if you are on the 5% tax slab, you still have to pay 20% tax with indexation. So please be aware of that. So the ETF will track the Nifty Bharat Bond Index. This is maintained by the NSE, and it will initially be constructed with AAA bonds. And if the bond gets downgraded to AA, it will still remain in the index. Only when the bond becomes below investment grade, it will be removed. That is below triple B minus, it will be removed away from the index within 5 days. But if it falls below AAA, if it becomes AA, it will remain in the index up to the next rebalancing. So, for example, if there's a bond which is AAA today, and it has become a AA bond tomorrow, it will remain in the index until the next quarter. Then it will be replaced with a AAA bond. But if the bond has fallen below investment grade, it has actually become a junk bond, then it will be immediately removed within 5 days. So it is a misconception that the index will only have AAA bonds, because up to one full quarter, in the index can carry bonds which are less than AAA. So that's very important to understand. These are important things, because when you sell the bond in the middle, credit rating changes will impact your the return that you make. Interest rate changes will impact the return. The risk will be higher in a 10-year bond than in a 3-year bond. So you have to be careful about how you play this thing. So if you hold it up to 3 years, because they are public sector organizations, the risk of default is low. Even if it becomes AA for extended periods of time, it's even if there are changes in the portfolio, the risk of default is low. In that sense, it's okay. But do not assume that you will get the indicated yield, and that is wrong. And we'll talk about that as we go along. So the current portfolio is available. You can look at the link, or you can look at the index fact sheet. I'm not going to read that. Now the thing is, in a closed-ended ETF, is that you can hold it until the end of the ETF, until maturity, and then you can the money will be given back to you. You need a demat account to hold this. Without a demat account, you cannot buy this ETF, which is a downside. At least many people don't have demat accounts. I mean, I think if they had made it into a debt mutual fund, then it would have been a lot more accessible to the general population, in my opinion. But they are hoping for institutional guys to come in, and that's the reason why they want the ETF. So the thing is that they chose this kind of a hybrid model, that it can be traded live, but it also has a maturity. This hybrid model was chosen because I think they want to give institutions like pension funds, etc., something safe. That is, they can hold it until maturity and get rid of the interest rate risk and get rid of the credit default risk by just holding it until maturity. The returns are not guaranteed. The principal is not guaranteed. Remember that the Bharat ETF has a side pocketing option. It can create segregated portfolios in case of defaults. So it's possible, and that's the reason why they are having it. Minimum 1,000 rupees, maximum 2 lakhs during the NFO period. After that, they can do whatever they want. And there is a big misconception that if they see that 6.9% indicated yield of the portfolio, many investors think they will get that. That is wrong, because the interest from these bonds will be reinvested into the portfolio. They will be reinvested at current prices, and if the yield of the bonds is lower at the time of the reinvestment, that is, the price is higher, then the overall yield will be lower. And also, if the AAA bond becomes AA and gets replaced only after 1 quarter, then the indicated yield will correspondingly change and it will be reduced. Therefore, even when you are holding up to maturity, you are not sure about what return you are going to get. Don't go by what you read in the media. Many people have made too much about this predictable returns. No, the returns are not predictable at all. It is mis-selling to call this predictable returns. It's wrong. Don't assume that AAA is the highest form of security. It's not. It's based on past data. Things can change. Public sector bonds are safe compared to a corporate bond, but in of themselves they can default and they can get into trouble. BSNL is a 100% government owned company. It's a PSE, and they are not able to pay salaries. I mean, that's how terrible it is. So it is a bad situation to be in. So for 3 years, I think it's a reasonable buy, although we'll talk about a better option. For 3 years, yes, credit risk problems can be minimized with this bond. Over 10 years, don't buy it because the PSUs are getting disinvested, so their credit ratings will change. Nobody knows what will happen. There can be big trouble, so don't ever buy the 10-year ETF with the hope of locking it in for 10 years. That's just stupid. So if you try and sell the bond before maturity, yes, you will face the full interest rate risk and the credit risk, especially for a 10-year bond. It will be very, very high. So be careful what you're getting into. We had talked about the taxation. If you sell it within 3 years, if you sell it, it will be taxed as per slab. For the 10-year bond, even if you sell after the 3-year period, even if you sell midway, it will be taxed only with indexation, with 20% with indexation, 20% tax with indexation. Are there better options? My suggestion is that you can consider an arbitrage fund, which is a safe fund, which has got safe bond. You have full liquidity, and the taxation will be favorable. Up to 1 lakh will be tax free, and after that it's only 10%. And so you can get a comparable return to this ETF, I would say. If you're a senior citizen, 50,000, there is a 50,000 tax exemption on fixed deposits that's not available in the ETF. So still, fixed income options are better off than this. So that's what I would recommend for long-term goals. Don't use the 10-year ETF. You can use different debt funds, arbitrage funds, or even long-term gilt funds, depending on your risk appetite. Those are better options. You have full liquidity. You can manage the portfolio and control the risk and reward yourself. So that's what I wanted to say about this. I'm not particularly impressed. 3 years, all right, but for 3 years, getting how does it matter whether you are going to get 6.8% over 3 years, or 6%, or 5.8%, or 7%? The money is going to get out of your hands in 3 years. That's not going to become your wealth. I think we need to think long term here, and don't get swayed by what you read in the media. So that's what I wanted to say. If you have any questions, comments, please leave them below. I'll try and answer past comments. I've not done it. I will do it today. Bye bye.